I'm Erik Schatzker, and welcome to Bloomberg's Front Row. Today I'm talking to Ken Moelis, the legendary M&A banker. From the ashes of Drexel, where he worked for Mike Milken, to DLJ, to UBS, and finally to Moelis & Company, the firm he founded in 2007, Ken has seen the best and the worst of Wall Street. Now, thanks to the COVID-19 pandemic, he says it's changing like never before. The Zoom revolution means rainmakers can be productive anywhere, not just New York.
We are a talent business. I have to, and I want to attract, I want to motivate, and I want to retain the greatest talent in the world. And if that talent wants to do it in Florida, that's where we'll support them.
Ken is a straight talker, and he shares his unfiltered point of view on the following: when to put his bankers back on planes, what the COVID crisis means for big banks, the frenzy for SPACs, finessing CEO succession at a founder-led firm. Here's my conversation with Ken Moelis. Ken, there's a quote of yours that has stuck with me. COVID changes everything. What do you mean by everything?
Well, I can't believe I'm the first one to say that, but I think it really did change everything. It accelerated trends. I've heard, people talk about accelerating trends from anywhere from 3 to 10 years that were already in cycle. But we're seeing that across the spectrum of businesses, including our own. The energy and the intellectual capacity that was put out, and really what now is happening in business, where almost every single enterprise, no matter what you're doing, I don't care if you're a stay-at-home, whatever you want to call it, Zoom economy, or your travel economy directly affected in the negative way, every single boardroom, every single executive is rethinking their business model and is trying to change and adapt rather quickly to survive what is a rapidly changing world.
Take me back to mid-March, Ken. The reality of the pandemic is just setting in. Remember?
Oh, yeah.
Cities are locking down. The stock market is cratering. What's going through your mind?
I really had a moment where I was wondering, how are we ever going to do another transaction from our couches? Who's going to want to do a transaction? And I can almost picture where I was. I was in my backyard pacing on my cell phone and talking to our executive committee. And we were literally trying to figure out what happens if, the world comes to a standstill. And when I say the world, the deal market, but it wasn't clear what was going to happen. That was a full lockdown. I think the March 15th was the full lockdown about when it started. You had truly no understanding of the virus, if you think about it. So the real question was, how could things get back to work? People were really leaving their mail outside for 2 or 3 days. People were scared to deliver pizza. I remember how truly shut down. What shutdown meant in that day was shut down, and it was because people didn't understand what was going to happen. So we didn't understand what was going to happen.
Did you wonder in those darkest hours whether the firm you built might not make it, might not even survive?
Maybe in the darkest of the darkest, but we have no debt and we have a lot of excess capital, and so we prepare. I think I thought to myself, if anybody's prepared for it, it's been us. We are one of the few companies in the world, in the middle market, that is zero leverage, capital light, and we were sitting with excess cash. But that's not to say we didn't cut our dividend immediately, just in case. I think until you understand a risk, it's better to stand back and really give yourself distance between the risk. So, Erik, I did not think that, because I thought there would be. I just didn't know what would happen to the rest of the world if we ever got to that place. So I didn't, but I did think this is going to be very difficult, and it could be very difficult, I should say, for our employees, our clients, and everybody that we interact with. Yeah, so I'd say that first week, I was very worried about, all those things.
Fast forward 9 months, effectively, to now, and things are very different. Deal making is going gangbusters. What explains that?
The public market in the last 9 months, while we've been all dealing with, have radically changed how they evaluate growth, how they evaluate fixed income payments. There's been a tremendous change in that. And every company, I think, has to really stand back and then look at their capitalization and their valuation and reevaluate that as well. So that's what we do for a living. And I think that's what's driving the deal environment right now.
Can it last?
Yes, I think it can. Because this change, although it happened fast, is going to have legs. I think we're not
tail.
Or a tail, both a tail and a legs, I guess. But it's gonna last for a while, and the ramifications of this are going to be political. They're going to be social. They're going to be capital oriented, and I think they'll go on for a while. And so I think I do believe people will change their business model and respond for a long time.
When you say the ramifications will be political, will be social, what do you have in mind?
I think we're only halfway through this crisis. I think there's 2 more crises to follow. There's been a dramatic, I think, I really think it's been unfair. The small and medium enterprise in America, and I just saw somewhere that there's 30 million of them, are truly getting obliterated. And I actually think right now, it's almost like a war feeling where people are very upset with the decision-making around that. There's been erratic decision-making on closures, on what closes, why it closes. And the American people are good at heart. They really are, and they're trying to do the right thing. When they step back and start evaluating this in retrospect, I think we're going to have another wave of anger and examination of the decision-making that went on during this crisis. And those people will not, they're getting hurt, and they're not going to be happy, and we'll have to deal with that both socially and politically. So I just think the ramifications of something like this don't end when the virus ends. I'm a student a bit of history. I love reading history. And to me, the amazing part is whenever you look back, often a war sets in motion a series of events that don't manifest themselves for decades. But you can almost see the pendulum start swinging as a result of the destabilization of a major thing like a war. And then it 2 decades later, something happens, but you can trace it back to that moment.
Most of your business these days is on Zoom. I'm guessing you never imagined that your bankers could be this productive, not getting on a plane multiple times a week.
I didn't even know Zoom existed till March 15th. And I don't think I'm overstating that. I think my first reaction on March 15th was, what's Zoom? So yes, I've never would have thought this. Again, when I say COVID changes everything, that's one of the things that changes. I think we all woke up. A lot of people woke up and said, wow, you mean we could have done this without flying 20 hours and drafting a document in a room together? We always could have done it this way. I really think this is a moment of enlightenment on certain parts of travel. It's also a moment where we remember that other parts of travel are fantastic. Having dinner with a client or your partner or your family is not replaceable. I think we'll go back to that. But I think some parts of this, I'm stunned at how I have a meeting that I was supposed to be at this week in the Middle East. I'm on the West Coast. That's a full week for me. It's sort of 20 hours, give or take, to get over. You need to go to sleep once before you have a meeting, and then you need to come back. That's a week. And Erik, I would have described that to you as a great week if the meeting was good. I would have said, what'd you do last week? I had a great week. I flew we had a great meeting. Well, that meeting will be over in 1 hour, and I'll be back right here in my chair ready for the next meeting. So yeah, I've never seen anything that's increased efficiency more, and I would have guessed it. You're 100% right.
Can those efficiencies last beyond the pandemic?
Yeah, I think they will. I think we've all realized some parts of what we did are just not efficient, and they're expensive. And so I think we'll cut out, not all of them. 1 out of 3 meetings will get cut out, maybe 1 out of 2 reasons for travel. But then again, maybe you'll fill those in by traveling and having more relationship-based meetings or family opportunities. I'm not saying travel might be for different reasons, because I really do miss having a meal and having a relationship-based eye-to-eye meeting with the client. I mean, I miss it as much with my family, but we are talking business, so I'm focusing on that. That's a real missing element, and I know a lot of my fellow partners and everybody in the firm's missing human contact. But there's a lot that can be done without it.
I wondered to myself if it doesn't very quickly become a slippery slope. If everybody's doing business on Zoom, Ken, doesn't the face-to-face meeting halfway around the world become the killer app?
Yeah, well, that's what's going to happen. It's nuclear disarmament works if everybody puts their arms down. The minute somebody picks up the travel armament, which they will, that's life. There's going to be somebody who says, I think Ken's going to stay home and Zoom this meeting. I'm going to go visit, and that will be a difference, like I'll say. And all of a sudden it will return. So I think travel comes back. It's a competitive benefit. If my doctor said to me, look, Ken, I really don't want to see you anymore. Let's just Zoom, and another doctor want to see me, I think I know who would be my doctor. So I do think that that's an important element of it. I just think that that commodity meeting, where we all know each other and we're going to do some commodity style work, maybe it's draft a document or compare due diligence notes. I think that might go on Zoom forever, but I do think, I think that it's a competitive world. There's some young person who's trying to take my job, and they will get on an airplane, and it'll motivate me, or maybe I'll get on an airplane and I'll motivate them.
Ken, back in 2018, you were worried about eliminating the so-called SALT deduction, right? The state and local tax deduction, and the impact eliminating it would have on cities like New York and Los Angeles. If SALT was a punch in the gut, is COVID the knockout blow?
I love New York City. I love New York City, and I want it to survive this, but it needs to be a place where people will return their capital over the long haul. Look, I know New York City will survive. I just want it to be not another decade before it comes back. And I think the more you send the signal that we're capital and tax unfriendly, just the longer it'll take for somebody to come back and restore New York City to where it was.
Do you care where your people work anymore?
Not as much. I'm not sure I ever cared. We always spent a lot of time out of the office. I'd walk the offices, and bankers in their office were kind of, that's not where you do your work anyway. So I think I'll be much more forgiving about where people live, you might say. And I think we're going to be much more flexible, not forgiving, flexible about where people live. And but I do want to have an office, and I want to have, we will have an office, and we will have a central point, because there is, one of the things that we did do was develop a great culture before the pandemic hit. And so when we all went to Zoom, we knew each other. We knew who we were, and we knew what we wanted to do. I don't think that lasts 10 years. I think you want to have a central point where you glue that down, and especially your young people who just come in. How are they going to understand your culture without physically feeling it? So we are going to have an office, and we are going to try to make it a central point.
Where will that office be? Your headquarters are in New York City. You have a big office in Los Angeles. Is that going to change?
New York City, as I said, will always be New York City. So I think it'll be our center. Will we think about moving to environments that are more tax friendly and where our executives want to work from? Yes, we will think about that. We've made no decisions, but I think it'll be demand driven. I think our executives will want to work in places that are lower tax rate, corporate friendly, and maybe warm.
So if one of your bankers were to say, Ken, I want to move to and work in Palm Beach, that's okay?
Well, I've had more than one say it, Erik, so it better be okay. And yes, the answer, I mean, I'm making a joke of it because I think I've had 20 say it. And the answer is we are a talent business. I have to, and I want to attract, I want to motivate, and I want to retain the greatest talent in the world. And if that talent wants to do it in Florida, that's where we'll support them.
Now, is that likely, if you're going to open up a new location, will it be Florida? Lots of people are going to Florida. You know them better than I do. They've also gone to Texas. They're thinking about Arizona, Nevada. What appeals to you?
I'm actually going to facilitate where the people want. It's funny. The Northeast sort of likes Florida. California has chosen Texas, it seems, as its destination. But we have so many more people. New York is where there's 8 to 10 times more people that we employ in New York. It just seems like New York has a destination. New York and Chicago, by the way, tend to look to Florida. Look, Texas is fine. We have an office in Dallas because we had a very smart employee who told me, I think 3 to 5 years ago, I love you, but I love zero taxation better. And Dallas has a great airport, and why not move there? So we already have a satellite in Dallas. So I wouldn't say we're against that either.
And what about you personally, sitting in Los Angeles, ever so in love with that 14% state tax? What does Ken Moelis do?
I'm just hoping they raise it so I can contribute more to society.
Ken, how about managing the workspace? Will you require employees to be vaccinated?
I won't. No, we won't require that unless, look, subject to what the government does. I'm very much a proponent of trusting your people. So no, the answer is I won't require it. But the government, I don't know what the government will do.
How about the rest of Wall Street? We saw what happened after the financial crisis, big changes, a new pecking order. How does the pandemic change Wall Street for good?
Look, I think any time you've had a crisis, having a portfolio of assets is a liability, because no matter what happens, COVID has changed the direction of the world. And that's what happened in 08, 09. Certain companies that had a large portfolio of assets didn't even make it out of that crisis, if you remember.
I do.
Yep, and that happened in 1990. It happened in 98. It happens every time a crisis hit. Large banks are, I call them, they're a library of your past mistakes. Usually the assets are a library of things you might not want when the world changes. So I do think there'll be change. Wall Street will change as a result of this. We are undergoing the same change as everybody else is. And that's why I love where we are, by the way. I think asset light, high intellectual talent, and low asset is going to be where you want to be, just like every other company. I mean, you look at what's going on in Silicon Valley. Having a bunch of legacy assets is not what anybody wants.
Hang on a second. JP Morgan is the largest, most powerful bank in the world by virtue of the fact, or at least in part by virtue of the fact, that it has a balance sheet bigger than $2 trillion. You're telling me that's a liability?
Could be. It depends what the assets are.
You're very proud that Moelis has been able to raise money for clients without a trading floor, without a research department. What does that disintermediation, as you call it, Ken, say about the legacy businesses of the JP Morgans, of the Goldman Sachses, of the Morgan Stanleys?
Maybe 30, 40 years ago, when I started on Wall Street, you did these little roadshows and you went to retail offices because you sold your investments retail, literally office by office. Today, the asset amalgamations and concentrations are significant. It's an institutional base. And so sitting at home in front of my computer, I probably can reach 90% of the asset base that a large trading floor can do. Why not do it that way? And why not have a much more highly intellectually delivered opportunities, and why not disintermediate the markets? I think it's happening, and I think that's going to be a big story over the next 3 to 5 years as people realize the same thing Uber and Lyft did to owning a car. We might be able to do that. I think we can do it to the big trading floors. Look, there are no trading floors right now, Eric. Nobody has a trading floor.
SPACs couldn't be hotter right now. Where do they fit into this equation?
Interestingly, I became much more attuned to SPACs 5-6 months ago. When I realized what they are, they're really misnomered, special purpose acquisition corps. They're really not acquisition corps. They're special purpose IPO vehicles. And what they are is a regulatory arbitrage. There's been almost no innovation in the IPO system except for direct listing. But not everybody can direct list. Direct lists are for, brands that are well known and marketed, marketed by themselves. But this SPAC market has allowed people to cut 7, 8, 9 months off of an IPO process, number one. When I went public 6 years ago, it took me almost a year from the time I said, let's go, to the night I priced. And Eric, I didn't know the outcome until that night. You don't actually know what's going to happen to you. You have some view within 48 hours, but really anything can happen, as we have all learned in markets, and you don't know anything until the final night. So now you cut 7 or 8 months off of that. I'll tell you, any entrepreneur, and at the time, I consider myself a bit of an entrepreneur when we went public, holding your company together and going through the 12-month period and getting everybody revved up and not knowing is very, let's put it this way, it's not a great feeling to have everybody on hold awaiting an event. So if you can cut 7 or 8 months off, you're doing people a real favor, and they'll pay for that. And secondly, because of the IPO regulations, SPACs are mergers. So high growth companies, especially, and that's why you're seeing such an amount of high growth, hyper growth companies, I would say, using the SPAC as an IPO vehicle. You get to use projections, whereas in an IPO, you don't, because of the underwriting laws and the litigation risk. But in a SPAC, you're merging, and mergers use projections. So a company that's growing 50 or 100% a year can tell their story much more effectively. And then lastly, they have certainty. Once you enter into a deal and you enter into your PIPE transaction, you pretty much have certainty going into the final 2 or 3 months that your deal's done and you have a price, and it's not all riding on the last evening. So I think the SPAC market has much more grounded, real benefits than I really thought of a year ago, and I think that it's going to continue to be a preferred vehicle for going public.
Ken, there's a view among investment bankers that fundamentally they're immune to the forces reshaping the economy: automation, machine learning, artificial intelligence. What do you believe? Are they immune?
I think about it every day. I worry about that. I try to stay ahead of it. And yes, I think we're just as susceptible to everything you've seen. I do think someday in the future, you will say, Alexa, tell me what I should bid for this company. What are my comparables? Alexa investment banker or Siri investment banker. I don't want to pick on anyone. And we may have you might have a better banker in an AI machine. I don't think that's in the next 5 or 10 years, but I've always underestimated how rapidly transformation comes.
Ken, you were one of the few CEOs on Wall Street to predict the Trump victory in 2016. Are you surprised he lost in 2020?
I think Donald Trump could have done things without the vitriol and the invective and the tweeting and some of the things that I think probably caused him to lose. And because I thought the policies, if you put a blindfold over and you put your earmuffs on and a blindfold on and you just read the policies, I think they were pretty good. The trouble was with some of the staging.
Ken, in 2019, you kept compensation levels at Moelis up at a time when revenue was soft. And in retrospect, the decision looks awfully smart because you have the people you needed for all the business that showed up when the pandemic stabilized. What does that say, Ken, about your philosophy of how much to pay people and when?
Well, you're right. At the end of last year, I thought it was an easy decision in my mind. The stock, some of my investors didn't like it. Some of the
you were criticized, yes.
The shorter term people, I had some long term ones. Maybe they were just being nice to me, but they called me up and said, you made the right decision. They probably told you something different. But look, people make investments all the time. I'm amazed at how many, if you buy a third party investment and you sort of pay too much, you write, nobody seems to care. But here I probably took, it was only an extra couple of percentage points of revenue. It might have been $15 million on what was a 2 or 3 billion market cap company. And I decided to invest it in my own. I decided to make sure, I almost call it, rebuy my own franchise and reinvest in it and make sure we had happy, motivated, committed bankers. And I knew it. And by the way, it didn't hurt Erik that I'm the largest, or maybe now I'm the second largest, but I'm one of the 2 largest, counting some institutions. I'm a very large shareholder of Moelis Co. To think that I'd be thinking of some short term, I am thinking of long term. I'm thinking like a stockholder. And I knew the idea was to keep the franchise, that there would be tremendous opportunities on the other side of this. So it was a fairly easy decision.
I'm going to ask you a question I know you hate answering. The Ken Moelis I'm talking to right now is inextricable from Moelis & Company. You're the CEO, you're the chairman, you're the controlling shareholder. You also happen to be one of, if not the biggest rainmaker at your firm. If your firm is worth $3 billion, Ken, how much of that is you?
Erik, it's funny. The board asked me about succession, and I said, they go, what happens if you get hit by a bus? And
That's a good way of putting it.
Well, I said, if I'm up there, I hope I'm up there. I'm assuming that. Let's just take that for a given. I said, I hope the stock goes down. I would be really, I said, I always feel bad for the people who get fired. Something happens to them and the stock goes up. I hope somebody thinks it was negative that I'm not here anymore and mad at the bus driver.
Most founders want their companies to outlast them. Is that your plan for Moelis? Or will you sell to somebody? No,
I'd like this to continue. I've worked for, I have no desire to sell. Let's leave it at that way. I really don't. I don't know. I don't even think the people who would be interested are the long-term winners, as we've talked about. I think we could be a long-term winner. I think we could grow this in several different directions. And I have no desire to sell it. I think it's a great vehicle. Again, it is public. It is debt-free. It's got a culture you can't replace. Do you know how hard it is to start an independent investment bank without getting everybody in a commission structure and fighting with each other over the commissions? It's very hard because of just the nature of starting from scratch. Nobody wants to pay for the other guy's losses. It's just the way it works. It's the way bankers think. We did. So we have a very unique culture, unique franchise, and I think unique opportunity. And no, I have no desire to sell.
So let's talk about what's next for you. The last time we talked about succession, you said you'd name somebody to be your successor as CEO well before you turn 65. You're going to be 63 in, I think, July.
That's right. Very good. How'd you know that?
So what happens?
Last I looked, that gives me 2.5 years. And as I said, I still want to do it. I think we're on track to do that. I think it would be good for the firm. I think it'd be good for me. By the way, I'm not leaving. I just want to be clear, Erik. People say that just gets rid of some of I love being with clients. I wouldn't mind getting rid of some of the operational stuff that drives you crazy. There's a lot of things that happen day to day that don't have to do with the act of being with clients.
So I'll just be the provocateur. Why not do it now? If you're already thinking how much better life would be without those encumbrances, without those annoying responsibilities.
Did you accept the job offer? Is that what you're saying?
I mean, some of the potential successors are known, perhaps some aren't. You once told me your successor definitely could be a woman, not necessarily. What's your latest thinking on all of that?
I think we have phenomenal people and so I think it's open to a lot. By the way, we have a woman who's the COO of the company who's driven us to this place. She was, I really believe, my first or second co-founder, and she's driven the success of the firm to this place. Elizabeth Crane's fantastic. And we have lots of great bankers. And so it's not the exact right time. By the way, COVID didn't help. It's hard to, I'm not saying I would have done it, but this has been kind of a lost year of integration of people. I mean, we're booming in terms of deals, but again, not everybody's in the same room. And so I do want to do it, and I'm committed to doing it. I'm still pretty youthful. I hope I feel that way. 62. And I'm not going anywhere. I think it would free me up to spend more time with clients, more time in boardrooms, and more time thinking of innovative things like this capital markets approach we're doing in the SPAC market, and things that could grow the company multiples rather than, incrementally.
Ken, on that note, I want to say thank you very much. It's been great having you.
Eric, I always enjoy talking to you. Did you accept the job offer?
I'm going to have to think about it.
Okay. You got 2.5 years.